If you ever thought investing sounds so complicated and you don't know where to start, this video is for you. Whether you are a student, a young professional, or just someone who wants to make their money work harder, I'm going to break it down all for you, step by step, so that by the end of this video, you will know exactly how to start investing, what to invest in, and how to avoid common mistakes. So let's get started. So in this video, I'm going to take you through quite a number of outlines, and they're just meant to guide you from the time you decide you want to invest up until the time you actually start investing. So it's quite a detailed one, so stay tuned and learn. So let's start with the big question. Why should you invest? Imagine you've got £1,000 sitting in a savings account and earning you just 1% interest per annum. Sounds safe? But here is the problem. Inflation in the UK is around 2.53%. That means your money is actually losing value to a tune of 2% per annum. So that £1,000 today might only buy you something worth £980 next year. Investing will help your money to grow faster than inflation. For example, if you had invested £1,000 in FTSE 100 10 years ago, by now it could be worth around £1,700. So that is even after the ups and downs in the market. That is the power of investing. It is not about getting rich overnight. It's about building wealth over time so that you can achieve your goals. So whether you're buying a house, you're retiring early, or just having more financial freedom, investing is one thing to consider. The second most common question when it comes to investing is, what can I invest in? Now, you can invest your money in different ways, but here are the most common options. Number one, individual stocks. Individual stocks represent your ownership in a single company. So when you buy a stock, you're purchasing a small piece of that company, known as a share. As a shareholder, you own a fraction of the company and you may benefit from its growth and profits. So how do individual stocks work? When you buy a stock, you become a shareholder, which means you own a tiny piece of the company. So for example, if a company has got 1 million shares outstanding and you buy 1,000 shares, that means you own 0.1% of the company, making you a shareholder. And also, if the company performs well and the stock price increases, you can sell your shares for a profit if that is the aim of buying the share in the first instance. And also, these companies, they share their profits with people like you, the shareholders, by paying you dividends, which are regular cash payments. An example, let's say you buy 10 shares of Amazon at £100 per share. If its stock price rises to say £150 per share, your investment will be worth £1,500, giving you a £500 profit. Alternatively, if Amazon pays a £2 dividend per share, that means you would earn £20 in dividends. So you are actually cashing in on the growth as well as the dividends that this share has been able to generate. So you can either invest in a growth stock or a dividend stock. A growth stock is the one that the shares are expected to grow faster than the market average. So the second one is the dividend stocks. So that is where a company would pay you regular dividends, and a lot of people will do this in particular just so that they can earn passive income. If that is the goal of you investing, then you could consider investing in stocks that pay dividends. The pros: number one, high returns. 2, you earn dividends. Number 3, you are part of the company by owning a piece of the company, so there is ownership. And number 4, flexibility, meaning that you can choose exactly which company you want to invest in. And what are the cons of individual stocks? Number 1, they are a bit risky, so they can be quite volatile and you could lose money if the company performs poorly. Also, they can be time consuming because they require you to research before you pick the right stocks. There are a lot of things that you have to watch out for. You have to go through the fact sheets to understand a few basics about the stock before you actually put your money to it. And there is lack of diversification. So when you invest in a few stocks, it can be risky if one performs badly, and that is your money gone. Another way to invest your money is buying ETFs. These are exchange traded funds. So ETFs are a basket of stocks or bonds that tracks an index, like the FTSE 100 or the S&P 500. ETFs offer investors like you and I a way to gain exposure to a basket of assets. So like stocks. So when you buy any ETF, you're buying stocks, you're buying bonds, or even commodities. And it's a way to buy within a specific index or within a particular sector or a specific market. All of this at a low cost than individual stocks. An example of ETFs in the UK stock exchange market is the FTSE 100. FTSE 100 is a stock market index that represents the performance of the 100 largest companies listed on the stock exchange by market capitalization. It is one of the most widely followed stock indices in the UK and is often used as a benchmark to gauge the health of the UK economy and also the performance of its largest companies. So if anything happens to FTSE 100, then we need to look carefully into the economy of the UK. So when you invest £100, for example, in FTSE 100, what you're doing is you're investing in companies from various sectors such as finance, energy, healthcare, consumer goods, and also technology. Examples of companies in FTSE 100. We've got HSBC, we've got BP Oil, Unilever, Shell, and a host of other companies. So another example of ETFs, especially in the US, is the S&P 500. The S&P 500 is a list of 500 of the biggest and the most influential publicly traded companies in the United States. And it aims to track the performance of the S&P 500 index, meaning its value should move in line with the performance of those 500 companies. So if the S&P 500 index goes up, the value of your S&P 500 ETF should also go up and vice versa. So examples of companies that are in the 500 index is Nvidia, ExxonMobil, we've got Netflix, Johnson & Johnson. So why invest in ETFs? A lot of people do because of its diversified portfolio. So ETFs will let you spread your money across many assets, reducing risk. Another thing is because of its low cost. ETFs typically have lower fees than actively managed funds because they passively track an index. It's quite flexible. You can buy and sell ETFs anytime during the market hours, just like any other stock. It is quite transparent as well. ETFs will disclose their holdings on a daily basis, so you would always know what you are investing in, the price, and also the cost. So ETFs are just a bunch of goodies, and they are broken down into index funds. So this one are the funds that track a specific index. For example, again, like the FTSE 100 or the S&P 500. And we've got the sector ETFs. They focus on a specific industry like technology or healthcare. We've got the commodity ETFs. They track the price of commodities like gold, oil, or agricultural products. And the bond ETFs invest in a portfolio of bonds, providing regular income to their investors. And then the international ETFs, they provide exposure to foreign markets like the US, Europe, or emerging markets. So what are the pros of ETFs? Why are people really sticking with ETFs? It's because you can spread your risk across many assets. It's typically cheaper than mutual funds. It's easy to buy and sell on stock exchanges. Holdings are disclosed daily and access to a wide range of markets and sectors. And what are the cons of ETFs? ETFs are still subject to market fluctuations. Some ETFs may not perfectly track their underlying index. You have to know that. While ETFs are low cost, if you frequently trade, you can add up to your charges and fees. With thousands of ETFs available, it can be hard to choose the right one. So another way by which you can invest your money is by considering real estate investment trust called REITs. So this is you investing in property without buying a physical house. Imagine your friend collects £100 from 3,000 people, giving him £300,000. He then uses that money to buy a property, rents it out, and shares the rental income with all 3,000 people who had given him money in the first instance. That's a simple way to explain a REIT. It allows anyone to invest in properties without needing to buy one themselves. So think of it like you own the front door, somebody else owns a window, and a few other owns the bricks, which means together everyone owns the entire property and shares in the profits. The risk in REITs is moderate, and that is because getting started with REITs is much easier than buying a physical property. It is not like you need a huge down payment or a mortgage, and there is no need to deal with agents or solicitors. However, you do need to understand how REITs work. They own things like offices, shopping malls, apartments, hotels, and much more. And they get their income through rents. So if you want to make passive income, if that's the essence of you investing, REITs are well known for paying high dividends. And this is because the law requires them that they distribute at least 90% of all their profits to their investors as dividends. That's a lot. So as long as the REIT is doing well and its properties are rented out, you can earn a steady stream of passive income. In short, REITs are a simple, accessible way to invest in real estate and earn passive income without the hassle of being a landlord. So whether you are a beginner or even a seasoned investor, they are a great addition to any portfolio. Another thing you can actually invest your money in is gold and commodities. These are tangible assets that have been valued for centuries as stores of wealth, investment tools, and essential raw materials. It means that you can hold on to these assets and use later without losing significant value. They are known as hard assets because they are tangible, unlike stocks or bonds, which are financial instruments. So why do people actually invest in gold? Number one, inflation hedge. Gold often retains its value when the purchasing power of money decreases due to inflation. During economic crises, stock market crashes, gold prices often rise as investors seek stability. Adding gold to your portfolio can reduce risk because it doesn't move in sync with stocks or bonds. So how can you invest in gold? You can buy physical gold, which is you buy the gold bars, the coins, or the jewelry. And there are gold ETFs. Like I said before, the ETFs are in different sectors. So you can invest in exchange traded funds that track the price of gold, like the iShares Physical Gold ETC. And you can actually buy shares in companies that mine gold, like the Barrick Gold or Newmont Corporation. Now let's look at the good things about these assets. It's tangible asset with intrinsic value. Historically, it has maintained value over a long term. There's no reliance on a company's performance, unlike stocks. The return you earn on gold solely comes from the price appreciation of the gold when it is sold. And what are the cons? Number one, it doesn't generate income like stocks or bonds. So there is the extra charge of the storage and the insurance cost for the physical gold. And prices can be volatile in the short term. The other part of gold is commodities. And commodities are raw materials or primary agricultural products that are traded on global markets. And they fall into four main categories. You've got the energy, that is where you have your crude oil, natural gas, and gasoline. You've got the metals, and that's where you have the gold, silver, copper, and platinum. Also the agricultural part, which is where you have wheat, corn, soya beans, coffee, and so on and so forth. And then you have the livestock. Examples, we have cattle, pork, and poultry. So why should you invest in commodities? Number one, they are there to hedge against inflation so that when prices go up, your commodities prices also will go up. And for diversification, they don't always move in sync with stocks or bonds, making them a good way to spread your risk. The supply and demand is also a good one why people would invest in commodities, because they are influenced by global demand weather, and geopolitical events, so creating opportunities for profit. So how can you invest in commodities? Number one, there are lots of ETFs that track commodity prices, like the InvestingForDB commodity index. So you may just want to look into that and see if you want to go with it. You can buy shares in companies that produce commodities like oil companies or mining companies. Another way in which you can actually invest in commodities is by getting involved in futures contracts. So this is where you invest in commodities just to hedge against price fluctuations or to speculate on market movements. That is where there are agreements to buy or sell a commodity at a set price on a future date. And so that can be arranged between the investor and the seller. So the pros of commodities: number one, they are tangible assets with real world uses. They can perform well during inflation or economic growth. Diversification benefits for your portfolio is one great reason why it should be considered. Then the cons: highly volatile because of the supply and demand factors. It also has these extra charges for storage and transportation for physical commodities. And futures trading can be quite complex and risky for beginners. Another way to invest your money is by investing in bonds. Bonds are essentially IOUs issued by the government or the companies or other organizations to raise money. So when you buy a bond, you are lending your money to the issuer in exchange for regular interest payments and the return of your initial investment when the bond matures. So think of it like this: you are the bank that the company or the government is coming to when they need money, while the bond issuer is the borrower. So how does it work? So let's say you buy a UK government bond for £1,000 and they give you a coupon rate of 5% per annum, and the maturity, for example, is 10 years. Here is what happens: you lend the UK government £1,000. So every year the government pays you 50% in interest. That is 5% of your £1,000. So after 10 years, the government repays your £1,000. So over the 10 years, you would have earned 500 in interest plus your 1,000 initial investment. So why should you consider investing in bonds? It's the steady income for the majority of people, because bonds will provide predictable interest payments right from day one, making them ideal for income-focused investors. And the safety as well, because government bonds are backed by the government. So there is that unlikelihood of it defaulting. And also for diversification, bonds often perform differently from stocks, so they can reduce risk in your portfolio. And also preservation of capital. So if you held it till maturity, bonds will return your principal, making them a safer option than stocks. And there are different types of bonds. You've got the government bonds. That is the one issued by the government to the public. And you've got the corporate bonds. These ones are the ones issued by the companies to raise money for expansion or operations. And you've got the municipal bonds. So these ones are the ones issued by the local governments, or councils, just when they need money to run their projects. So what are the pros of bonds? Predictable income, as regular interest payments provide stability. It has a lower risk because it is backed by the government. It can help you to diversify your portfolio and help balance riskier investments like stocks. And like I said before, capital preservation. So you get your principal back at maturity. What are the cons? Bonds generally offer lower returns than stocks over the long term. So if interest rates rises, bond prices fall, and vice versa. If inflation outpaces the bond's interest rates, your returns lose value. Corporate bonds can default if the company runs into financial trouble. So you have to note that. Now, choosing what to invest in. With so many options, how do you choose? You start by asking yourself 2 questions. Ask yourself, what am I investing for? You need to understand this because it's going to help you to be disciplined and to stay consistent. You want to know whether you are investing for short-term goals, and these goals will last between 1 to 3 years, like saving for a holiday, saving for a car, or an emergency fund. Are you investing for medium-term goals? This will take between 3 to 10 years, like buying a house, starting a business, or funding education. Or are you investing for a long-term goal? That would usually take between 10 years and above. So for example, retirement, building generational wealth, or even for your own financial independence. So once you are able to understand why you are investing or what you are investing for, then that is half done. The second thing that you want to ask yourself is, how much risk can I handle? Because the stock market needs you to be able to answer this question so that you know what to put your money into. So how much risk can you handle? Is it low risk? Then you'll be preferring stable and steady returns. Is it medium risk that you can handle? Then you'll be looking at something that is comfortable with some ups and downs for higher returns. Are you somebody that is willing, or ready for high risks? Then you should be willing to take big risks for the chance of big rewards. So once you've provided answers to these 2 questions, then you can match your goals to your risk tolerance. If you are a beginner or prefer low risk, I would suggest ETFs, index funds, and also government bonds. If you're somebody who is comfortable with moderate risk, then REITs, dividend stocks, and also balanced ETFs and mutual funds, I would say that you consider. If you're willing to take high risk for high rewards, try individual stocks, growth or tech stocks. If you are in your 20s and saving for retirement, you might want to focus on stocks or ETFs. If you are closer to retirement, you might lean towards bonds or REITs for steady income. So let me know how you get on, what you've decided to choose, and if you can just leave that in the comment section so that we'll learn from you as well. How much should you invest as a beginner? This is a common question that people do ask, and the answer actually depends on your financial situation. A good rule of thumb is to invest money you won't need for at least 5 years as a starter. So you want to start with what you can afford. Maybe £50 a month. That's enough to begin. Many platforms allow small investments. Some even take £1 and some £25. So you decide based on what you can afford, what you're going to start with. And one thing, if you do not have an emergency fund set, it's better you do that before you start your investing proper, because that is going to help you to stay focused and also consistent. If you don't have any money set aside for emergencies, it means that when an emergency occurs, you are then going to dip your hand into your investment pot and take from it. That is not what you want happened. So it's always advisable to save 3 to 6 months worth of expenses in a high interest savings account before investing. Investing in stocks and shares means that you need to plan the money you earn, that's the income that you receive from whatever business that you do. So you may want to follow the 50-30-20 rule. What this means is when you earn any money, you set aside 50% for needs. Needs include rent and bills. Then 30% for other expenses or wants or entertainment. And then 20% for your savings and for your investing. Once you've decided on how much to invest, automate your investing amount. Set up a monthly direct debit so that you can invest consistently. And lastly, do not overcommit. Understand your financial status and apply the rule of thumb where it is necessary. So this is another question that I do get asked. When is the best time to start investing? The best time to start investing is today, right now. Time in the market is more important than timing the market. Even if you start small, the sooner you begin, the more time your money has to grow. Don't wait for the perfect moment. It does not exist. Can you lose money investing? Yes, you can lose money investing because markets go up and down and there's no guarantee of returns. For example, during the 2008 financial crisis, many people saw their investment drop by 30% or more. Some actually lost theirs 100%. But historically, markets have always recovered and gone to reach new highs. The key is to stay calm, avoid panic selling, and focus on the long term. So before you invest, make sure you have an emergency fund. You've paid off high interest debts like credit cards. And also you have a budget so you know how much you can afford to invest. Investing is important, but your financial health comes first. I have a link in the description to a budgeting template and you can grab yourself a copy. So to start investing, you will need an investing platform. In the UK, the popular options include Trading 212, Agrips Lansdowne, Vanguard, and AJ Bell. These platforms let you buy and sell investments, and many have low fees for beginners. Do your research and choose one that fits your needs. So what type of account should you use for your investments? In the UK, the best way to invest is to open any tax-efficient account. Number one is Stocks and Shares ISA. With Stock and Shares ISA account, you can invest up to £20,000 a year. And all the profits or the interest that you earn on that would remain tax-free. You can use it for long-term growth. So you can buy your ETFs, your stocks, and mutual funds with your money in the Stocks and Shares ISA. And you have all the platforms operating these Stocks and Shares ISA. And even some banks do have this as one of their products. So you can look into that and consider it if it suits, your purpose. Another account you can open is Lifetime ISA. For short, it's called LISA. So this one is good if you are a first-time home buyer or you want to use it for your retirement. The maximum you can put in this account is £4,000 a year. The great thing about it is you get a 25% government bonus on your investment in that account on a yearly basis. So if you had £4,000 in that account, the government is going to top it up with another £1,000. But it has its age restrictions. So you have to be between 18 years and 39 years before you are allowed to open one. Another account that you can consider is a self-invested personal pension called SIP. In this account, currently in the UK, you can save up to £60,000 into that account per year. And all the interest earned on that 60,000 will remain tax-free. So you see how interesting it is. So information is really powerful. Don't put your 60,000 in any other account that is not any of these tax-efficient accounts. If you do so, you're going to get interest or capital gains tax applied to that investment. Now, what's next? You've known the basics. It's time to take action. You start by opening an investment account. Set a budget. Choose your first investment. Remember, investing is a marathon, not a sprint. You've got to stay consistent, keep learning, and you'll be on your way to building wealth. If you found this video helpful, give it a thumbs up and subscribe for more tips. Thanks for watching, and I'll see you in the next one.